Hello students, this is Professor Vincent Isaiah. Welcome to my class. This is the presentation of part 5 of auditing the revenue process. This is where we left off in part 4, control activities and test of controls, specifically on sales returns and allowances. Now, as you know, we have two issues here. Sales returns, that's a situation whereby the customer returns some goods to us for whatever reason, and allowances, the customer gets to keep the goods, but we are asking the customer to pay less than the regular price. Again, I'm talking from the standpoint of the company that we are auditing. As auditors, the question is, what are the control activities relative to regarding ensuring that sales returns and allowances are properly recorded. So we can actually test one of these. The most important thing here, or one important control here, is all credit memorandum has to be authorized. So when we talk about credit memo, the company that we are auditing will issue credit memo to the customer and ask the customer to pay less or have a refund to the customer. Either way, we have to make sure that those transactions are properly authorized. Moving along, let's take a look at relating the assessed level of control risk to substantive procedures. What are we talking about here? The result of our assessment of the control risk has a direct relationship to how much detailed work we have to do. That is the substantive procedures in this area. So the auditor testing of control for revenue processing impart the detection risk. Detection risk relates to how much work we have to do, and therefore the level of substantive procedure imparted by the controls in this area: accounts receivable, sales, cash, so on and so forth. Now let's take a look at the auditing revenue related accounts. We already talked about revenue related accounts and revenue related records. So substantive analytical procedures are used to determine plausible relationship among revenue related accounts, right? We did talk about analytical procedures in the past. That's a relationship whereby we establish relationship between our financial and non-financial information in order to get an insight into a particular issue. So we also bring that to play here. So here are some substantive analytical procedures, all right? So I'm just going to go ahead and give you an example of one of the 5 that they enumerated here. Number 5, take a look at this. Large customer accounts balances compared to last period. So let's assume that the total revenue for our clients that we are auditing is $100 million. $100 million in 1 year, $120 million in another year, $110 million in another year. So the average is about $100 million. But guess what? Our client that we are auditing has one customer that they sell 90% of their goods to, or that they generate 90% of their revenue only from one customer. So guess what? One way of actually taking a look at the validity of total revenue is to take a look at a comparison of that particular customer, or comparing that customer's account balances from period to period or from last period. If we do that and that is intact, we can simply assume that every other thing is okay without getting into all the details for the other customers. So additional examples of that. And of course, allowance from collectible accounts and bad debt expense is also another issue. I just discussed that with you in a minute, and I think that is another issue we need to talk about. So, allowance from collectible accounts, we have to make sure that it is reasonable in order for the accounts receivable not to be overstated. All right, age, trial balance of accounts receivable, we did talk about this. There's a situation whereby the client would put all the accounts receivable into different ages. from 0 to 30 days old, 31 to 60 days old, so on and so forth. Why are we interested in the age trial balance of accounts receivable? Because if most of the receivables are 60 to 90 days old, or maybe more than 120 days old, and this is a situation whereby most customers pay within 30 days, then we know that most of these accounts receivable very likely will not be collected. Therefore, we are going to watch out to see whether enough allowance for uncollectible accounts or enough provision for uncollectible accounts was made by the client. All right. So completeness. The question is whether all accounts receivable has been included in the accounts receivable subsidiary ledger. That is the main concern for the auditors. And one way of getting around this is to see whether the client engages in monthly reconciliation of accounts receivable subsidiary ledger with the general ledger, because we have one account in the general ledger that is a controlling account, or one account that is a summary of all the accounts in the accounts receivable subsidiary ledger. So that reconciliation has to be done on a monthly basis, and that will assure the accuracy of that account. Cutoff. The question is whether all transactions tested are recorded in the proper period. So if we ship out goods to a customer on the 29th, December 29th, and the transaction has been consummated, then that transaction needs to be recorded as revenue in that particular year, even though we wind up receiving a payment in the following year. So the question is whether proper cutoff has been taken care of. Existence and rights and obligation. So existence is one of the more important assertions for accounts receivable. Okay, the question is whether this accounts receivable is not overstated through the inclusion of fake or fictitious customers amount. Okay, so we have accounts receivable of $300 million. The question is whether every customer that is included in this $300 million actually owe the company that we are auditing. So how do we know that? So first of all, before we talk about the confirmation, one thing we have to do is make sure that the valuation is intact. What does that mean? When we talk about valuation of accounts receivable, we are talking about whether adequate allowance or provision has been made for allowance for doubtful account. So let's take a look at the situation that we have here. If the customer have $200 million accounts receivable and they make provision for $10 million that might not be collected, so at the end of the day, the customer is telling the whole world or reporting $190 million net realizable accounts receivable. But guess what? If actually the provision for bad debt or uncollectible account should be 20 and not 10, then the accounts receivable should be $180 million. So this is a valuation issue. Why is it a valuation issue? Because the allowance for uncollectible account is an estimate. All right. So the bottom line is also an estimate. So moving along, classification. We need to make sure that the presentation disclosures are also intact. So if accounts receivable is going to be received in 3 or 4 years, then it should not be classified as part of current assets. Usually accounts receivable, all accounts receivables are current assets. But in any situation whereby that is not the case, then it should be properly classified. The confirmation process, accounts receivable, what are we talking about here? Here we are talking about sending confirmation to customers and asking them to confirm whether they actually owe the company that we are auditing. So we call that the confirmation process. Is the audit evidence that is a direct written response from third parties about the accounts receivable balance? Okay, so it's a very good evidence. So guess what? We send, the question is, who actually writes the letter to customers asking them to confirm whether the company owes them or not? Actually, the client or the company that we are auditing actually write the letter. But we actually write, the auditors write the letters for the client. And then the letter will indicate that the client should respond directly to the auditors, okay? So if we receive a lot of responses from those customers and those customers actually badge and agree that they actually owe our customer, then clearly the accounts receivable is solid. So omitting confirmations, sometimes we don't bother with confirmation as auditors. And here are some reasons why we don't even bother to do confirmation. Number one here, accounts receivable balance is so immaterial, it's insignificant, why bother? Then let's take a look at the factors affecting the reliability of accounts receivable confirmation. So it depends on the kind of confirmation that you are using. There's one confirmation we call positive, another one we call negative confirmation. What does that mean? Take a look at this. Positive confirmation, we are actually asking the client to respond to the confirmation. Negative confirmation says, respond if this information is not right. So the letter is written to the customer and said, you owe XYZ $20,000. Get back to our auditor if otherwise is the case. But if that $20,000 is right, you don't have to. That is negative confirmation. So the timing, when should we send confirmation? We can send confirmation at the end of the accounting year for the client. You can also send confirmation during the year also. What are the confirmation procedures? I just thought to talk about that very briefly. Of course, the client has to send the letter, but the auditors actually write the letter for the client. So for examination purposes, who writes the confirmation letter? The answer is the client that we are auditing writes the letter, even though we write it for them. Now, moving along, alternative procedures. This is not a big deal. These are alternative procedures to the procedure that we just talked about. Auditing other receivables. In addition to accounts receivable, we have other type of receivables. Receivable from officers and employees, so on and so forth, notes receivable. So we have to look into all of that as well. Evaluating the audit findings. Eventually, we need to go ahead and evaluate our audit findings. After all said and done, we need to see whether the accounts receivable is fairly presented or not. So that is the conclusion of chapter 10 presentation.